The bigger issue, and this goes back to the economic theory that Mr. Buffett started as far as talking about market cap to GDP. Over the very long run, the growth of the stock market can only be as much as the growth in corporate earnings. Because if you look at history, PE ratios are going to go up, be above average, they're going to go down, they're going to be below average, they're going to come down in line. Dividends have to come from earnings. So all of your growth in the stock market comes over the long run from your earnings. All of your earnings growth for US companies comes from the growth in your economy. If you have one industry doing really well, you're going to see competition, profit margins will go down, earnings will go down, stock prices go down. So what's critical if you're a long-term investor is what's our long-term expected growth rate of the economy? So looking at that, simple economic theory, your long-term economic output comes down to how many people are working and how productive are they? What are they producing? So this chart shows that equation. The dashed line is the sum of that equation, where you have your productivity and your labor force. Well, what do we see happening with our labor force, which is this bottom line? Why is it going down? Why is our labor force going down? It's simple.
We're all getting older.
We're all getting older. The baby boom generation, we saw a boost in two-income earners. We saw a big influx of workers. Now the labor force going down as they retire. That makes sense. What surprised me is everybody tells you how much more productive technology has made us. I mean, I look at this thing here and the computing power it has and compare it to when I started at Strategic Equity in 1998, when I used to have this big old thick laptop that made this thing look miniature. And then I'd have to get to the hotel room and most of the time unplug the phone, stick it in, start my internet connection, go take a shower, come back, log into AOL, go do my ironing. I mean, we should be more productive. But how many of you have ever had your hard drive crash? Poor Tim, poor Tim spent probably 5 hours trying to get his Outlook to sync to his Salesforce database. If your cell phone has ever been lost and you don't have a good backup, I mean, technology should make us more productive, but it hasn't. The bigger issue is you got to realize the U.S. is a developed economy. We're not an emerging market like China. We're developed. What happens throughout history in a developed economy is the more wealthy your country becomes, the more demands your workforce has. They want higher wages. They want more vacation time. They want a shorter work week. They want or are forced to have health care. Whatever it is, your labor force becomes less productive because they cost more for the company. The net output goes down. So our productivity rate is not there. And then we see companies, rather than investing in long-term projects, decide I'm going to borrow money so that I can buy back shares and pay dividends. That's a warning sign. They're not investing in the long term. We need long-term projects. And I promised Peter I wouldn't go into politics. So this is all I'll say. Look at the person you're supporting, both for president and for Congress, and figure out, do they have a legitimate policy to either increase our labor force and or increase our productivity? If they don't, they're bad for the economy. And if you have a question on that, give it to Peter. So that's an issue. One other thing, you notice we're growing below our potential for a really long time. Why do you think that is? The U.S. is not a closed country. Our exports are smaller than our imports. Therefore, we pay money that leaves our system. Our debt level means we're paying back. Debt is essentially future growth borrowed. So we're pulling forward the growth. We've been doing it since the 1980s. So our debt level means we're already running below potential. So for a long-term investor, if you've been tempted by the returns of the S&P 500, not only do you have the valuations working against you, you have our long-term potential growth working against you. But guess what? That can change. You just got to be ready to pounce on it. The valuations will look favorable. I'm confident. This election doesn't give me much confidence, but at some point, Americans are going to wise up and they're going to find candidates that figure out how do we grow our labor force and how do we make them more productive. And I'll give you a hint. The answer is somewhere between the far right and the far left. There's good things about the right and there's good things about the left. The answer's somewhere down the middle. And America's going to get it right because America always gets it right. We're just a little bit stubborn.